Welcome to this Gillick Explains video, and welcome to a sort of retrospective 5 investing lessons from a fairly torrid 2022. Certainly a year where plenty's been happening. So what lessons can we draw for 2023, if you like? Now, you hardly need me to tell you, I've told you at the front of a few videos now, that it's been quite a year. We've had war. There's been war on some part of the planet for decades, but the Russia-Ukraine war has been pretty brutal and had a pretty devastating impact across big swathes of Europe and elsewhere. Inflation has taken off. Now, it may come down again, hopefully, but it has taken off in 2022. We've had rate rises, the reversal of QE to try and combat it, so central banks stepping in. We've had lots of volatility. So the question then becomes, what are the takeaways, if you like? So what are the positives? So what I'm going to do in this video is to make an observation, justify it, and then pull out a lesson. And there are 5 of them. So observation number 1 is that trouble can come from almost anywhere. Places that investors thought were one-way bets only 12, 15 months ago have turned out to be, one-way bets, but in the opposite direction almost in 2022. So examples. Bonds, for years, bond prices did nothing, yields were tiny, interest rates were low, and then suddenly, bang, in the middle of 2022, we had yields suddenly rising, prices going all over the place, volatility in a part of the market where often people don't expect to see it. Big tech had a bad year. Again, these are the so-called FANG stocks, what used to be called the Facebooks, the Amazons, the Netflix and so on, the Googles. Obviously the names have now changed in quite a few cases, but those suddenly fell to earth. Well, not to earth perhaps, but suddenly expansion at the rate they'd been enjoying ground to a halt in 2022. And then of course, cryptocurrency investors know only too well, if investor's the right term, how that all ended or is ending in 2022. So far so gloomy. What are the lessons? Well, there's quite a few lessons you could pull out, but number 1 for me is diversification is more important than ever in order to avoid overexposure. All right, it's really key that you don't put all your eggs into the big tech basket or the, heaven forbid, the crypto basket, or pile from equities into bonds because yields have moved. All right, it's really important to spread risk and spread wealth over a number of different baskets, and within those baskets, stratify out again. Number 2, observation first of all. The UK and the pound have had a bad year. Now, not for the first time. You can go back several years and the pound's been struggling, but there's no two ways about it. The UK on several measures is pretty much at the bottom of the G7. Doesn't look much better in terms of the G20 at the moment. We've had, and in terms of your currency weakness, inflation numbers, productivity is what I mean by bottom of those clubs. Rapid changes in government have not helped. At one point it was a chancellor every month, if you look at a certain part of the year, pre-Jeremy Hunt. And the pound sunk at one point close to parity with both not only the euro but the US dollar. It's recovered a little bit since then as I make this video, but that's pretty bad. That's a vote of no confidence from the currency markets, if you like. The lesson, is there a positive to get from all this negative stuff? Yes. If ever there was an observation that justifies investing overseas, getting some dollar-based investments, for example, surely the weakness of the pound has to be it. Because if you've got, as a UK investor, investments in dollars, and the dollar's relatively strong against sterling, then you get the benefit when you translate back into sterling. So globally diversifying investing overseas, I'd have thought, must be the takeaway from this year if it hasn't been previously. Observation number 3, interest rates rose pretty sharply. Thank you, Tim, we know about that, but we've had interest rate rises seemingly every time the Bank of England's met recently. Okay, same is true for the Federal Reserve in the US and various other central banks. So what's going on? Well, inflation has rocketed. As I make this video, it's still double figures. Central banks got behind the curve. Everybody got a little bit complacent about price rises and the effect of the pandemic, if you like, on supply chains. So central banks were a little bit slow to act and are playing catch up. Debt costs have spiked, of course. We notice interest rates rising in terms of mortgage costs, personal loans, businesses, and all the rest of it. So the obvious lesson, watch out for leverage. I've said it before, this is no time to gear up beyond your means of covering interest. Now, in real terms, by the way, inflation actually, in real terms, eventually brings down the cost of debt. The government quite like, believe it or not, a little bit of inflation because it helps them, and borrowers can end up better off after periods of high inflation, but only if they can afford to carry the interest cost, which will be significantly more in the meantime. Number 4, we saw volatility return with a vengeance in 2022. It's always out there somewhere, but crikey, the evidence is everywhere. The CBOE VIX fear gauge is still, as I sit here making this video, way above its long-term average. Daily stock moves, if you look at the FTSE 100, for example, of 3 to 5% have almost become commonplace. Risk assets, mentioned this earlier, have taken a hammering. And yet, the bigger markets are showing signs of doing that almost mythical thing called the Santa rally as I make this video. So it hasn't been all bad news. Stock markets have not given up the ghost or thrown in the towel. Which means my next lesson, which I've mentioned before, has to be very, very, very careful to avoid market timing. Because a lot of people might have looked at 2022, the benefit of hindsight, and said, well, the one thing you can be sure of is stock markets will collapse. And yes, at certain points during the year, they've had a pretty rough ride, but you'd be mistaken in thinking that the economy and the stock market move at the same speed or even short term in the same direction. Stock markets look ahead to better times, look ahead to inflation coming down, perhaps interest rates coming down, and therefore they don't necessarily track what's going on the ground. Number 5, observation number 5. The stock market has shifted a bit. There's no two ways about it. Cyclical stocks have suffered in 2022. Defensives have picked up a little bit of momentum. Yields have improved is the good news. So people looking for income, people looking at how they're going to pay for their post-work period, for example, they need income, and improving bond yields, improving dividend yields are the sort of good news. But the point is, the stock market has seen a little bit of a shift. And therefore the lesson, the observation I'm going to draw out here is, fortune favours the well-prepared. People who won't mind the fact that you get these shifts sometimes in sentiment are the people who've got their rainy day funds set to one side, no danger of liquidating some of the beaten up technology stocks yet because they've got their cash reserves in place. They can see their foreseeable calls on capital coming and have got the relevant bond strategy in place to meet those, for argument's sake, and their lifetime savings can then be allocated to the market taking a long-term view, not rotating on the basis of sort of 1 year's information, but taking that long-term view. Whereas other investors who are less well prepared will be chasing the market, worrying about, do I dump all my cyclicals, do I buy lots of defensives, sort of panicking, if you like, about what's going on. That is never a good idea. So there you have it. 5 basic lessons from 2022. There are others, but those are things to think about in 2023. To find out more about some of the stuff I've just been talking about, because I throw in a lot of jargon with these videos, please go to killick.com/learn, and maybe the shares tab would be a good one for this one, or the investing principles tab. If you'd like to find out more about equity investing in written terms, there is a light blue guide, editor@killick.com. Unsurprisingly, it's called How to Invest in Equities, or you can pick one up at one of our locations. And then there's Confidant, and there's usually a chunky section in there, quarterly flagship magazine from the equities team, and that would be editor@killick.com for a digital version.